If you've got a steady paycheck and want to dial down stress, a systematic investment plan, SIP, usually wins. If you're sitting on a big chunk of cash and markets look cheap, a lump sum can hit harder, faster. The best choice isn't universal, it's about your cash flow, your risk tolerance, your timeline. Quick definitions. SIP. Invest a fixed amount regularly into a mutual fund, monthly, quarterly. It's boring in the best way. You buy more when prices drop, fewer when they spike. That's rupee cost averaging. Builds discipline, smooths volatility, suits long-term goals. Perfect for salaried folks and beginners. Lump sum. Put a large amount to work at once. Immediate exposure. Money compounds right away. If a bull market follows, you capture the full upside. Timing risk is real. If markets fall right after, the hit feels bigger. It's harder to stay invested. 2025 context. With inflation pressure and global uncertainty, SIPs are the safer default for most people. Over 10-15 years, SIPs often match or even beat lump sums thanks to consistent averaging. But if markets correct sharply and look undervalued, a well-timed lump sum can be a smart play. Decision checklist. Somnath. This one's for you. Cash flow. Regular income. SIP. Large surplus. Lump sum. Market condition. Volatile or unclear. SIP. Clear undervaluation. Lump sum. Risk appetite. Conservative. SIP. Aggressive. Lump sum. Goal horizon. Long-term like retirement or education. SIP. Short-term tactical bet. Lump sum. My bottom line. SIP for steady wealth creation. SIP for risk control. SIP for discipline. Lump sum when you have excess funds and strong conviction on timing. Or mix both. Keep the SIP running. Add lump sums on meaningful market dips. Pick the lane that lets you sleep at night. And stick to the plan.